Hello, everyone. Today on the final bar, I'll be talking to Julius de Kempenaer from RRG Research. We'll talk about this rotation that just continues to churn around. The S&P chopping around right around that 45.50 level, pushing above it today on a closing basis, which is certainly noteworthy. But what's actually driving things higher? You take Alphabet out of the picture with communication services, it's pretty defensive. You have REITs and utilities second and third. We'll look at all of that, including a deep dive into the FANG stocks. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using data visualization techniques, the technical analysis toolkit to better quantify investor behavior, focusing on the message the markets give back to us in the form of price action, breadth, sentiment, and much, much more. Today, we're going to talk a lot about rotation, right? And sort of have this environment where it's all about some of the previous leadership and some of the newer leadership. You have energy, the top performing sector year to date by far, and it's not even close. I think second is probably still financials, but it might be sort of choppy there after that. But on a day like today, you have much more of a defensive feel. You have the market going higher, but it's led by communication services and then things like real estate, utilities, healthcare, all of which are sort of thought of as a little more defensive than offensive. So how can we think about this sector rotation and what it means, right? What stocks are actually propelling the S&P to new swing highs? We've talked about the deteriorating breadth conditions a lot in recent months. We've talked about how November, December into January really saw weakening breadth characteristics by any measure that I've seen. We're now seeing a lot of those bounce higher here, and the S&P getting above 45.50 could be a key indication reinforcing sort of a bullish take. The S&P, by the way, has now retraced 61.8% of the way back up of that January pullback, which is kind of an important level. Now, we have great guests on the show. I'm excited to talk to Julius de Kempenaer. He always does a great job of using the RRG methodology to better visualize what's happening underneath the hood. Tomorrow, we have Frank Capillari from Instinet coming to us from the New York area. Next week, we have Sam Burns from Mill Street Research in Boston, and then joining us for the first time on next Wednesday, the 9th, Carolyn Borden, an expert in Fibonacci retracement. So it'll be interesting to hear how her take, given a lot of the Fibonacci levels that many have been talking about recently. Also, a couple other special events to highlight for you. The Money Show, we're doing a Money Show virtual expo next week. Greg Schnell and I are going to be doing a presentation focused on cannabis stocks called Trading Cannabis Stocks Using Price Momentum. It's coming up next Wednesday, the 9th, 2 to 30 p.m. Eastern. You can go to stockcharts.com/moneyshow to sign up for that event. We'll be looking at some of the highly followed cannabis names in the US and Canada and focus on their trends using our scooter rankings and also pure looks at their price momentum. Also, my next webinar from Market Misbehavior will be coming up next Tuesday, February 8th, 1 o'clock Eastern, called Breaking Down Breadth. There is a double meaning to that one, breaking down as in the conditions have been breaking down, but also breaking down some of the commonly used breadth indicators and what sort of techniques we can use to better understand the performance of all the individual names that comprise those broader indexes. Let's continue on with our market recap today, brought to you by our friends at Trade Your Brokerage. You can go to the StockCharts ACP platform. There's a little Trade Your Brokerage note, a logo in the bottom right corner. It allows you to actually trade directly from the charts. On our market recap, we have to talk about the S&P pushing higher. We talked about a couple key levels on the S&P 500, 4,300 on the lower end and really below there, 4,220 to 30. On the upper end, we have 4,700 and then 4,800 is the all-time high at the end of last year, beginning of January. Now we're sort of right in the middle, but we've pushed back now over 50% of the way back up. The January sell-off pushed us down around 10 to 12%, depending on how you measure it. And now we've bounced up, and we look at the chart of the S&P here in a few moments, you'll see some key Fibonacci levels that are now coming into play once again. What's interesting to me, we closed yesterday right about at 45.50. We opened a little higher and bounced right off of 45.50 before moving higher. So if you didn't believe that that level was important, particularly on the tactical time frame, I would be watching that very quickly through the rest of this week. And whether or not 45.50 holds, I think now that we've closed above it is a key metric. I still don't believe in this idea that the bottom is definitely in and we're just going to shoot to S&P 5,000 plus. That could absolutely happen. I don't want to say that can't happen. It absolutely can. But I would say there's also a number of scenarios that involve us retesting those lows, involve at the very least a sideways period. I'm seeing plenty of conditions that show that that is actually more likely than I think a lot of investors are thinking, given the strength that we've seen in the last couple of days. Bear market rallies can look incredibly tempting, and I think there is a non-zero chance we're actually experiencing one of those now. The NASDAQ, by the way, underperformed the S&P, with the NASDAQ composite up 0.5% versus the S&P's almost 1% higher. Mid-cap's flat for the day, and the small cap index actually down 0.5%. The VIX nearing very closely the 20 level, pushing again lower today. Interest rates came off a little bit. It was up at around 1.8% earlier in the day, came off and finished today just between 176, 177 or so, and the dollar index coming off a little bit using the UUP. Gold higher today, about 1/3%, not significant, and the same with energy prices. Commodities as a whole up about 0.4%. The energy sector is up about 1/3% using the XLE. A lot of red on the charts of cryptocurrencies, by the way. And what's interesting about this one is if you think of cryptocurrencies as a general proxy for speculation, which I think is still pretty fair, as much as we have talked and many have talked about the long-term thesis on things like Bitcoin and Ether being institutional buy-in, being more and more companies and banks and others, payment processors, all being able to incorporate Bitcoin and Ether and others into their platforms. In the short term, I would still argue it is a lot of speculation. These are individuals making speculative plays on a relatively volatile asset class. And overall, you're seeing plenty of red on here. The charts of Bitcoin and Ether have been in an established downtrend for quite some time. I definitely buy into the long-term thesis on some of these, but in the short term, it's hard to see this as anything but distributive as long as we continue to see lower highs and lower lows. And these are both sort of bouncing off of relatively weak levels not too long ago. Let's go to a daily chart of the S&P 500. We review this most days on the show, and I just want to spend a few moments just to highlight the fact that as of today, the intraday high, and really on a closing basis, right about 61.8% of the way back up to 4,800. If you start the clock the first couple days in 2022, we go to the lows just around 4,220 a couple weeks ago. We have now retraced back to just below 4,600, and that's right at the 61.8% retracement level. If you look, we sort of chopped around just below the 38.2%. We bounced higher. Now, these are short-term Fibonacci levels, right? Only looking at the last month or so, but it's an interesting way to think about it. I put on here, by the way, 10%. If I remember right, you had that sell-off in February of 2020. You had the bounce higher before the big push lower, and that was a bounce of about 10%. Maybe 11% off of that first leg down, which is up to around 46.50. So, and this is why I think this market can still be in dangerous territory, right? We can go all the way up to 46.50 or so. I would argue still remain below 4,700, and another leg down could occur. And years from now, that will seem like the most reasonable downtrend, and this feels like a normal bounce higher. So I think, clearly defining your risk now is really important. We've talked about that for a couple months. I would say, I'd encourage you to remain diligent and focus on where you would need to take profits and where you would recognize that trends may not be working anymore. Now, when we do look at what's happening in the market today, you have Alphabet up 7.5%, and that's certainly propelling the communication services sector up to the top spot of the 11 S&P sectors. Google, it's an interesting chart right now, to be honest. It's bouncing right up to resistance. Earlier in the day, right at the open, it felt like, okay, this is jumping higher. It reminds me of the chart of UPS, big gap higher on earnings, opening above, breaking out of the space, and it feels like, okay, lights out. This thing is going to, most likely going to continue higher and higher. But if you look at today's trading, it was up a lot more earlier in the day. It chopped around quite a bit. It actually closed below 3,000. We've talked a lot of times over time on this show about how big round numbers tend to be important. Stocks tend to do things around 1,000, 2,000, 100, 10, 5. These are key big numbers that people pay attention to. Alphabet has gapped above 3,000, but has been unable to hold it on a closing basis. Until you close above 3,000, I think that's a pretty important metric to pay attention to. I won't get too much into some of the other FANG stocks because later in the show, we're going to focus particularly on each of the what I call the FANMAG stocks and look at each of their charts and what they're telling us about the overall environment. You're certainly seeing growth recovering very nicely. But it's interesting when I look at the top gainers today in the S&P 500. Alphabet number one, finishing the day up 7.5%. The second one, an energy stock, MPC. So Marathon, another earnings name this week. But when I look at the chart of Alphabet versus the chart of Marathon, one of these looks like it has been in an established uptrend, and today's gap is just simply a follow through on that established uptrend. And it's not Alphabet, it's something like Marathon Petroleum. If you look at the energy stocks, while they have had good runs, absolutely right. Is there space for these charts like this to pull back a little bit and still be within the context of a fairly successful uptrend? Absolutely. What you're seeing today is a gap higher and closing higher as well. And it's just the latest up move, a latest follow through move on a fairly established uptrend that's been so significant. Again, when you look year to date at sector returns, it's sort of energy and everything else. And I think it's absolutely a good idea if you have been in some of those names to pay attention to where you may want to take profits or unwind some of those. But at this point, if you want to outperform the S&P 500, as Tom Boley, our fellow contributor, has often said, if you want to outperform the S&P, you need to own stocks that are outperforming the S&P. And charts like MPC have certainly been getting it done. We need to take a quick commercial break. We'll be back with today's guest, Julius de Kempenaer. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we focus on the market environment using the technical analysis toolkit, using the analysis of price and trend and momentum to better understand what's happening with all of these names, tickers, ETFs that we're following. A couple quick announcements before we get to today's guest, Julius de Kempenaer. First off, we welcome your questions. We just had a mailbag segment on yesterday's show, had a lot of fun trying to dispel some common investing myths, but addressing questions on technical analysis and breadth indicators as well. Your questions are welcome via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions and hope to answer one of yours in our next mailbag segment on Friday of this week. Also, go to StockChartsTV.com. That's our on-demand platform. All of our market outlook specials from January, from Larry Williams, Martin Pring, many others did a great job sort of laying out what this year could look like. And a lot of their discussions are playing out just beautifully in terms of choppiness and volatility and uncertainty and rotation. Also, great guest appearances like Julius de Kempenaer and others on demand. Go to StockChartsTV.com. You can use your email to set up a free account. Also, on your mobile device, just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Julius de Kempenaer, back to the show. Julius is coming to us from the Amsterdam, Netherlands area. Julius, you're the founder of RRG Research, and it's always a pleasure to have you on the show. Welcome back.
Thanks, Dave. Glad to have you to be here again. And I wonder, why did it take you so long to invite me back?
I'll have to talk to our producer about that, Julius. But
yeah,
you're always welcome, as you know. Now, we feature the RRG often on the show, particularly when we're talking about the 11 sectors and how they're rotating. You've done a great job with some of the charts that you shared with me earlier today on breaking down the sectors into a couple different buckets. We're starting with this first group. Can you talk us through these three charts and why they're important? Here's the first one, starting with real estate.
Yeah, well, I hope that most of the people are now familiar with RRGs, and we got the drop down with a lot of predefined universes. And not too long ago, I stumbled upon, I was actually alerted to it by one of the viewers of Sector Spotlight. And he pointed me to Morningstar, where they broke down, or where they are breaking down sectors, because we used to talk about offense and defense. And sometimes I talk about the sector rotation model that was put together by Sam Stovall. And I had difficulty putting it all in one piece, and offensive, defensive just didn't seem to do the job. And when I ran into this breakdown, because what they do is they have cyclical, which is offense, defense, and sensitive. And all of a sudden that started to make a lot more sense to me, because sensitive were something like sectors like communication services and also technology. Because remember, we had technology going up while the market was going down. It was very sensitive sector. So what I started to do more and more is breaking down the 11 sectors into those 3 groups, and also doing that using the equal weight versions, basically to sort of single out. You just mentioned Alphabet with a, what was it, 7.5% gain, because they've got a huge impact on the spiders, the XLP, XLK type of stuff. They have a heavy impact on that. When you move to the equal weight versions, there's still an impact, but it's a lot less. So I feel that when you want to do this type of exercise, look at those types of rotations. If you go to the equal weight versions, you got a little bit more of a look under the hood. And that's the RRGs that we're going to look at. And the one that you have on the screen is the one for cyclicals. So it's real estate, materials, financials, and discretionary. Now, the big red tail is for discretionary. There's no doubt about that. That is right now one of the strongest underperforming sectors. And obviously, that's a big, even in equal weight terms, that's a big sector. And, when I look at this, you just have to look at this RRG just a fraction of a second to see that the dominant direction here is southwest, which is the stuff that we really don't want. Now, if you move to the next one, which shows you the defensive sectors, then here, snap, there you got it. They're all moving in the right direction. It's utilities, it's staples, and it's healthcare. Utilities and staples, there's no doubt about it. Healthcare is a sector that's been sort of confusing lately. But when you look at the tail, this is a weekly chart, so we're looking at a little bit longer term trends. If you look at that weekly tail, that's starting to pick up. That's starting to fulfill its role as a defensive sector despite its recent declines. And then when we go to the last one, that's the one with the sensitive sectors. You can see that sort of mixed picture, that confusing picture that the S&P is painting us right now. Obviously, the big green one is the energy sector. There's, everybody knows what energy has been doing. I think I did Sector Spotlight monthly charts last Tuesday. 18% energy was up last month. It's the only sector. Financials was kind of unchanged, but this was the only sector that was going to go up. If you look at technology and industrials, they're clearly going down. Those are the 2 red tails. And then we've got communication services, which just crossed into the improving quadrant. But look at it, how far it is to the left. And we all know how poorly the communication services sector performed over months. I think it's been months that it's really a strong underperforming, and it's now picking up a little bit. But I feel that this sector is at a high risk of rotating into improving and then rolling back over downward and going back to the lagging quadrant without ever hitting the leading quadrant. So if I sum all of this up, I think that under the hood, which is what you do with Brett, and I do that with this type of rotation, I still see a very strong rotation for defensive sectors. And that doesn't make me feel very comfortable with big long positions in the S&P 500. This could very well be a bear market rally. And we just have to be very, very, at least I am very, very cautious. I wouldn't dare to be 100% long right now.
I love this breakdown of the sectors this way. It's really, really helpful, Julius. And we only have about 30 seconds left, but I'd love for you to relate what you just described and maybe elaborate on how that relates to this chart of the S&P 500. I'm sort of talking about being cautious, being defensive, and I'm getting plenty of pushback from people saying the bottom is in, this is the next leg higher, you need to be in here. How do you relate what we saw with the sectors with this chart of the S&P, and what are you looking at here?
Yeah, it's what I just said. I mean, under the hood, it's the defensive sectors that are pushing this market higher. And I really question how much more power, because with technology and discretionary being the big sectors, and they're in trouble from a rotational point of view, you do need a very, very strong performance from all these lower capitalized sectors to balance out and even push it higher against those 2 really big sectors. So I have trouble seeing the S&P just blasting to new all-time highs from here.
It's such a great take, Julius. Listen, it's awesome to see you. Thanks for coming on, sharing some ideas with us. Stay safe there in Amsterdam. We'll talk to you again soon.
Thanks, Dave.
That's Julius de Kempenaer. Julius is the founder of RRG Research. He does a great job with his own show, Sector Spotlight, which runs every week on StockCharts TV. If you haven't seen that before, I'd encourage you to go to StockChartsTV.com, watch out some of his previous episodes. He does a great job of using that methodology consistently. I also wanted to mention, by the way, we were talking before the show, he was using all the equal weighted sector ETFs. And that's an important distinction. We often talk about consumer discretionary versus staples and why the equal weighted version is more interesting, I think, in a lot of ways than the cap weighted version. He took that analysis much, much further and sort of explained how to think about those equal weighted sectors. So go to his blog on StockCharts TV for this article that I'm showing on the screen to learn more about that particular part of that process. We need to continue on our next segment called the Sector Deep Dive. What we like to do occasionally is dig into a particular S&P sector and go a little further. I am taking a little bit of creative liberty this time and creating my own sector called the FANG stocks. And basically, we often talk about the dominance of the FANG names and why they are such a unique group, right? These mega cap tech, consumer communication services stocks, and how much of an impact they can have on the market. So for an example, when, on a day like today, with Alphabet up so significantly, it's hard to imagine the market as a whole looking that bad if you have names like that are ripping to the upside, just given the market cap that is present in that type of particular name. So what we're going to do, we're look at what I call the 6 FANMAG stocks, and I'll show you the chart of the FANG Plus Index, which comes from the New York Stock Exchange. We'll look at the relative performance of the FANG stocks, and we'll look at the 6 charts individually. We'll talk about some of the key levels that are in play here, because most of them reporting earnings either this week or last week. You had Apple and Microsoft last week, all sort of both bouncing higher this week after their earnings release, and then you've got more coming on this week here as well. And I would argue that one of the important potential catalysts are earnings, right? These the earnings releases that we're seeing last week, this week, and next week have the potential to really drive stocks higher or lower. And with the mega cap names, you really want to be on the right side of those as much as you can. Now, here is the FANG Plus Index, and I would caution you by saying that this is not just the FANG names. I sort of describe this as a FANG-y type of name index, if that's a word I can make up. It's $NYFANG. It comes from the New York Stock Exchange, but it's FANG stocks and then a bunch of other things like Twitter and others are in this. Some of the Chinese internet names, if I remember right. I haven't looked at the construction of the index in a little while, but at times it's had a lot of other things that are sort of in that growthy type of thing, all fairly large names, but with that sort of overall growth mentality to them. And if you look at the relative strength November, December, January, you can see that this as an aggregate, if you take all those names together in a basket, it's not been great. And certain ones of these have certainly been performing better than others. You'll see that when we look at the 6 individual names here. We'll start with the FAN, the first 3 names. This is Facebook or Meta Platforms at the top. We have Apple number 2, we have Netflix. And this isn't in a particular order, it's in the order of the acronym. So I probably could have organized these a little better. But going through one at a time, I have the 200-day moving average on each of these. And I would point out which of these stocks are above or below their 200-day moving average. So that alone will tell you, I think, a lot of what you need to understand about which of these names are really working and which are not. Compare the chart of Apple versus the chart of Meta and the chart of Netflix. Which of these is the outlier? And it's clearly, Apple, which is, recently made new all-time highs in December of last year, while the others were below their previous highs. Netflix actually topped out in November, lower in December, lower in January, and this is where we're at right now, having gapped lower and bounced a little bit to the upside. But Facebook as well, Meta Platforms, is below its 200-day moving average. And in general, I'm a fan of owning things that are above an upward sloping 200-day moving average, and I'm much less of a fan of trying to jump into things that are below there, because it tells you as the uptrend has clearly not materialized enough yet. Taking a step back on the chart of FB, you see a pattern of lower lows, and you see a pattern of lower highs. And so far, until we regain that previous high, which is around 350, I would argue this chart is still at the very least in a consolidation phase at most, or maybe at worst in a distribution phase. Apple clearly a bit of an outlier. It did undercut its December low in January, but overall recovering pretty well and not too far off of all-time highs. I think 180 is a really key level on the chart of Apple. We then round out the 6 FANMAG stocks looking at Microsoft, Amazon, and Alphabet. And again, you can see which of these are the outliers. Amazon, Netflix, Facebook, all below their 200-day moving average, the others all above there. And that alone shows you how there's a bit of a differentiation between these three. Microsoft is a really interesting one because it recently bounced off of its 200-day moving average. You arguably could say the same for Alphabet, undercut it just a little bit, but both of those back above their 200-day. And my question for either of these charts, does it hold the 200-day? I think for Microsoft, holding the 200-day moving average, holding 280, which would be the lows from last fall that we retested here just a couple of weeks ago, holding 280 is pretty key. And my concern with this market, it would not take much, I would argue, as much as this feels like this has been a nice rally off of the lows for the S&P 500, it would not take too much for these names to roll over. And if charts like Microsoft undercut their previous lows, this could look very ugly very quickly. So keep an eye on those key levels. It's a great opportunity to set a price alert on stock charts or some way to sort of manage that. I mentioned earlier the chart of Alphabet right up against a key resistance level. Earlier in the day, I started thinking, all right, this could be a blowout rally sort of mode for Alphabet, but it ended the day not really proving much. It gapped higher, that's encouraging, but unable to even close above the open, unable to close above those November highs. So it shows that there's a gap higher, but not enough of a follow through, not enough buying power to really push us above those previous highs. My question there, can Alphabet get above 3,000 and hold it? So when you think about the 6 FANMAG stocks, it reminds me of Julius de Kempenaer's illustration of those sectors. As much as it feels like we're thinking about the S&P 500, different sectors have had very different paths over the last couple of weeks and the last couple of months. And I think looking at the 6 FANMAG stocks, you see quite a bit of differentiation. You have things that are not too far off of all-time highs, Apple and Microsoft in particular, Alphabet, attempting to get above 3,000. Then you have the rest really still arguably in a position of weakness. We need to wrap up the show, go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number 1 is looking at Alphabet in our segment, a sector deep dive. I took some liberties and looked at the 6 FANMAG names, and I would encourage you to think about how those stocks are performing going into their earnings announcement, how they're performing after, but in particular focus on resistance and support levels. On all 6 of those, on my own charts, I have very clear levels delineated, and on Alphabet, I think 3,000 is a key one. If you're bullish on the stock market as a whole, if you think the S&P is going to blow out 5,000 and go even further in the near future, you need charts like this to eclipse their previous highs, and it really hasn't happened for the FANG stocks just yet. Chart number 2 is a bit of a different look. We're actually going all the way back to the March 2020 high. I was looking through some of my old chart lists, and I found this one. I'd been interviewed back here in the first quarter of 2021 on all the e-commerce stocks, and we looked at some of the ETFs. I was looking at iBuy, Online, eBiz, and Amazon, and at the time, I'm talking about how iBuy was up 200+%, while the S&P was only up 60-70% off the lows. And obviously what a huge theme this had been. Look at how quickly those names have rotated lower. And just today at the close, you have the S&P finally eclipsing all of the remainders. So the S&P over time, take away this huge volatility they've had, and just sitting in the S&P has ended up being a better long-term play. Now, again, my goal would be to identify when these trends are emerging, to manage your risk, and when these themes are no longer working. And I think if you're just buying something like this and riding it out for multiple years plus, you're missing out on some opportunity for alpha, some opportunity to outperform if you can be a little more tactical about it. Now, we had Matt Tuttle on our show a couple times before. Hopefully we'll get him back on here very soon, but his firm Tuttle Capital released basically a short innovation ETF. They don't call it the Short ARK Innovation Fund, but that's pretty much what it is. The ticker SARK should give you a hint of what they're actually trying to accomplish here. But if you look at this, it IPO'd or had its release back here in November around $30 a share. It's up to 46. That's down from the low 50s, but you can see overall a lot of IPOs have been struggling. This ETF, which has a short exposure to the names that are in the ARK Innovation Fund, doing pretty well, and it's worth following that to see if you continue to see some upside in a chart shorting some of those speculative names. Folks, that is our show for today. I want a special thank you out to Julius de Kempenaer from RRG Research, staying up a little late in Amsterdam to share some thoughts with us on sector rotation. Make sure you check out his show, Sector Spotlight, here on StockCharts TV. All of our previous interviews and episodes are on our on-demand platform, StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.